Today, growth stocks and growth ETFs are capturing a lot of attention. These are the ones making people very rich seemingly overnight. For instance, over the past year, top performing stocks like Carvana grew insane with nearly 400%. And this means that if you had invested $10,000 a year ago, your investment would now be worth close to $40,000. Who wouldn't want that kind of return? However, this high reward comes with high risk. Take SolarEdge for example, a company in the solar panel sector. This stock plummeted by 79% over the same period. An investment of $10,000 in SolarEdge would now be worth just $2,100. And such a drastic drop can impact your overall portfolio drastically. So it's no secret that this individual stock picking can be incredibly challenging, right? And many investors struggle with long-term success, especially when actively trading. And because of this risk, the smartest approach is to invest in a diverse group of growth stocks rather than betting on individual ones. By investing in a growth ETF that holds a collection of 100 stocks, you spread out your risk, and while some stocks may underperform significantly, others will deliver exceptional returns, helping to balance out any losses and have a great overall return. And therefore, in this video, I will quickly review 9 of the best growth ETFs available at this moment and review my top pick ETF. If I had to choose only one growth ETF for the rest of my life, this would be the one. Hi, I'm Maurice, and with over 15 years of experience in the industry, I help you grow your wealth the smart way so you can enjoy life today and in retirement, achieving the freedom you desire. And I guide you in building your own portfolio without the need for costly advisors, proving that managing investments is simpler than it seems. Right now, the biggest hype is all about AI. So let me share my favorite AI ETFs. By investing in an AI ETF, you can avoid the risk of putting money into just one company while still benefiting from the overall growth in AI technology. There are several good options out there, but I've picked my top 2 favorites to focus on. Now, specifically in these specialized sector type ETFs, you are going to find a higher expense ratio, something like 0.6% all the way up to 1%. Now, let's start with the first one, the Global X Artificial Intelligence and Technology ETF, the AIQ. It tracks the Index Artificial Intelligence and Big Data Index, focusing on companies benefiting from AI development. Year-to-date return 27.8%. Inception date is 2018 and the top holdings are IBM, ServiceNow, Alibaba, Cisco, Netflix, and Adobe. Number of holdings approximately 84. AIQ provides broad and comprehensive exposure to the AI value chain, resembling the Nasdaq 100 index but with a tilt towards technology and mid-cap growth. Then we have the second one, the Global X Robotics and Artificial Intelligence ETF, BOTS. Tracks companies involved in robotics and AI with a focus on hardware and application. The expense ratio is 0.68%. The inception date of this ETF is 2016. Year-to-date return 7.74%. Top holdings are Nvidia, Intuitive Surgical, and ABB. Number of holdings approximately 44. So BOTS tracks companies in industrial robotics, non-industrial robots, and autonomous vehicles, offering a different angle compared to AIQ's software-heavy focus. Next up, let's dive into semiconductor-specific ETFs. And why specific semiconductors? The semiconductor industry is a key driver of technological innovation and economic growth, especially in artificial intelligence, AI, and other high-tech fields. And therefore, the semiconductor market is set to grow from $573 billion in 2022 to $1 trillion by 2029. So let's dive into some of the best semiconductors ETFs like Van Eck Factors Semiconductor ETF SMH. Tracks the MVIS US listed Semiconductor 25 index reflecting semiconductor production and equipment performance. Expense ratio 0.35%. Year-to-date return 39.23%. 10-year return over 26% per year. Holdings are Nvidia, Taiwan Semiconductor, Broadcom, Texas Instruments, and the number of holdings are 26. SMH is a prominent choice in this sector, boosting impressive long-term returns and a diverse set of top holdings. Then we have Invesco PHLX, the semiconductor ETF. SOX tracks the semiconductor sector index covering the 30 largest US listed semiconductor companies with an expense ratio of 0.19%. Year-to-date return 24%. The 10 years return is over 25% per year. The top holdings are Nvidia, Broadcom, Advanced Micro Devices, Taiwan Semiconductor, and Texas Instruments. Number of holdings are 30. SOX also delivers strong returns with a slightly lower expense ratio than SMH, making it another excellent option. But please be careful here, because if you make the wrong choices, it could seriously cost you a lot of money. And let me tell you a quick story about an investor I met named John, who was eager to dive into the world of investing in 2007. With high hopes and a lot of enthusiasm, John poured all his money into a handful of hot stocks that everyone was talking about. And at first, it seemed like he was on the right track. His investments were skyrocketing, and his excitement was also sky high. But as time went by, the market shifted quickly. The stocks John had invested in began to plummet. John's portfolio took a serious hit, and in a matter of months, he saw his investments lose almost 80% of their value. The loss was devastating. John had not diversified his investments, and he put all his eggs in a few baskets. And when those baskets broke, so did his financial security. And the worst part was he had to start working again. He found it really hard to trust investing again. It took him years to recover financially and even longer to rebuild his confidence in the market, and with me guiding it through a rough period. John's story is a powerful reminder of the importance of diversification. It's easy to get caught up in the excitement of hot stocks or the latest investment trends, but spreading your investments across various assets can protect you from serious significant losses and help you maintain your long-term financial health. Now, therefore, for the investors who want to be more diversified, we are shifting gears to broad growth ETFs. These provide a wider scope compared to highly specialized sector ETFs. First one is one of my favorites, and it's Invesco Nasdaq 100 ETF, the QQQM. It tracks the 100 largest non-financial companies listed on the Nasdaq. The expense ratio is 0.15%. Year-to-date return 17.34%. Inception date is 2020. The 10-year return of the QQQ is 18.67% per year. The top holdings are Microsoft, Apple, Nvidia, Amazon, and Broadcom. Number of holdings 102. QQQM offers broad exposure to major tech giants with a lower expense ratio compared to its sister QQQ. And secondly, we have the Vanguard Growth ETF, the VUG. Tracks the CRSP US Large Cap Growth Index, and the expense ratio is 0.04%. Year-to-date return 21.7%. 10-year return is over 15% per year. Top holdings are Apple, Microsoft, Nvidia, Amazon, and Google. Number of holdings approximately 188. The VUG delivers robust growth potential with a low expense ratio, making it a top choice for broad growth exposure. And third, we have the Swap US Large Cap Growth ETF, the SCHG. Tracks the Dow Jones US Large Cap Growth Total Stock Market Index with an expense ratio of 0.04%. Year-to-date return 22.76%. 10-year return is almost 16% per year. Top holdings are Microsoft, Apple, Nvidia, Meta, and Google. Number of holdings approximately 251 holdings. SCHG stands out with a strong year-to-date performance and competitive long-term returns. And then last but not least, the S&P 500 Growth ETFs. These ETFs target growth companies within the S&P 500. They have strong historical returns and greater diversification, featuring a high number of holdings. And this broader exposure helps spread risk while capturing the growth potential. Number 1, the SPDR portfolio S&P 500 growth ETF, the SPIG. Expense ratio is 0.04%. Year-to-date return is over 23%. 10-year return is almost 14.8%. Top holdings are Microsoft, Apple, Nvidia, Amazon, and Google. Number of holdings, approximately 231 holdings. And then we have the next one, and that is number 2, the Vanguard Information Technology ETF, the VGT. Expense ratio is 0.1%. Year-to-date return is 18.9%. 10-year return is over 20% per year. The top holdings are Microsoft, Apple, Nvidia, and Broadcom. Number of holdings, approximately 318 holdings. These ETFs offer a balance of low expense ratios and strong performances, providing diversified exposure to both growth stocks and the technology sector. Because investing in a single hot sector might seem appealing, right? But if that sector underperforms in a few years, your portfolio could take a significant hit. And to avoid that risk, it's smarter to invest in ETFs with broad sector exposure. And this way, if one sector declines, the other sector within the ETF can help stabilize your investment. So among broad growth ETFs, QQQM, VUG, and SEHG are excellent choices. Each offers strong potential, but my personal favorite is QQQM. You don't need to limit yourself to just one growth ETF. To keep your portfolio diversified yet simple, consider holding 3 to 5 ETFs. For more guidance on creating a well-balanced portfolio that suits your risk tolerance and financial goals, check out my video here on building a solid 3-fund portfolio strategy which provides optimal allocation based on your age and investment needs.